Welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, New York City, we have Ravi Jain. He is the Director of Risk and Derivatives at Sterling Trading. We're going to take a look at the latest trends in electronic trading and the importance of cloud-based risk solutions. Ravi, it's great to have you back with us at MarketSite. And a couple of the trends that you're looking at is margin and its association to complex option strategies.
Right. Sure. Thanks, Jill. Margin calculations for equity and equity options in the U.S. Have become sort of dated, somewhat they're simplistic, and I'll venture to say they're actually somewhat archaic. And the easiest way to think about this is an example. If you look at Reg T margin at the simplest level, even equity portfolios in Reg T are margined, both initial and maintenance margin. All stocks, regardless of whether they're a large cap stock or a small cap stock, are margined the same percentage. And similarly, option portfolios, complex option portfolios, if you have an option spread that's an at the money, a short option spread that's at the money, or a short option spread that's deep out of the money, they're margined the same way. So the margin requirements are not synchronized or in sync with the actual riskiness of the positions.
It sounds like you almost need to overhaul the entire methodology for the options market.
Absolutely. I mean, and if you pivot for a second to portfolio margin, which was really meant for dealing with more sophisticated portfolios because of the stress test-based methodology, even under portfolio margin, every individual name is shocked the same 15%. So whether you're shocking a ultra large cap like Johnson & Johnson, or you're shocking Beyond Meat or a small cap biotech name, you're still shocking them 15%. So essentially what the margin calculations are doing is, in a way, they're rewarding portfolios that are higher risk because they can get the same leverage as somebody with a low risk portfolio. And so thus, I feel that there needs to be an overhaul and a more consistent framework for for margin calculations, in particular for heavy option portfolios. And now if you look at the CFTC, they use span margining for futures and options on futures. So there's no reason why E-minis on the futures exchange should be margined totally different than SPY or S&P options.
How is it different?
They use a span margining, which is based on different volatility adjusted shocks and implied volatility shocks, which is not done on portfolio margin.
So it sounds like that methodology makes more sense than
That's right.
we have
That's
it right now.
I would agree, yes.
So what about cloud-based risk solutions in the current market? Is this something that we can use to recreate this methodology?
So yes, so one of the things that can be done is, well, first of all, before we go to that, I just want to mention that because the regulatory framework is somewhat weak, most clearing firms or broker-dealers have to figure out their own calculations, their own add-ons or house policies, and for which they try to mitigate the simplicity of the regulatory framework by adding things like volatility-based calculations or liquidity-based calculations or market cap-based calculations. The problem is that's difficult to do, and for that they need fairly heavy, complex risk systems. Large banks can afford to implement large risk systems, but mid-sized or small broker-dealers or clearing firms, it's difficult. And that's where a cloud-based solution comes in. A cloud-based solution that does these calculations centrally using very modern technology can afford even a larger audience to be able to do such sophisticated calculations very easily without a huge investment, CapEx investment, in bringing in these large risk systems. And so that's the power of using the cloud, using quantitative techniques like we've done with our product, and offer not just the actual regulatory calculations, but also customize house policies or add-ons.
Would it be better for the industry for standardized instead of customizing it for each bank or broker?
Absolutely. My view is that the regulators should sort of come together, whether it be FINRA and CFTC and the OCC, and maybe do a task force or a working group to come up with a more consistent methodology that across all the different products in the industry. That would be better because it would create consistency,
right,
and it would create transparency. Clients would know exactly how they're being margined, as opposed to one clearing firm doing it one way, another clearing firm doing it another way.
This might be a simple question, but why aren't they doing that? Or are they in the process of?
I have not heard any attempt to do this yet, and I don't know why. I think it surprises me.
Yeah. Well, I guess until then, we'll just have to use cloud risk-based solutions
Yeah.
to make that happen. Thank you so much for
Thank you
joining
very
us
much.
at MarketSite. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.